If you're getting ready to sit for the Pennsylvania Property and Casualty Licensing Exam, you're in the right place. This video covers only what is specific to Pennsylvania: the state laws, the numbers, the deadlines, and the rules that Pennsylvania does differently from the rest of the country. It assumes you're studying the national property and casualty material separately. The general concepts like how a homeowner's policy is built, what negligence means, and how liability coverage works. We're not going to reteach any of that. What we're going to do is give you the Pennsylvania layer that sits on top of it, because that's where the state exam earns its questions, and that's where careful test takers pull ahead. Here's how Pennsylvania splits its exam, so you know why we spend time where we do. The single largest chunk of your test is insurance regulation. Pennsylvania law, the Commissioner's authority, licensing, and producer conduct. Then come the state's auto rules, its cancellation and non-renewal deadlines, its Guaranty Association, and its workers' compensation system. Those are the areas where Pennsylvania has made specific choices, and specific choices are exactly what a licensing exam loves to test. So let's build your Pennsylvania knowledge piece by piece, and by the end, you'll have every state number locked down. Every rule you're about to learn traces back to one office. Pennsylvania regulates insurance through the Pennsylvania Insurance Department, and the department is headed by the Insurance Commissioner. When the exam refers to the Commissioner, this is who it means: the state official with authority over insurance companies and producers operating in the Commonwealth. What does the Commissioner actually do? Start with who gets to sell insurance at all. Before a company can write business in Pennsylvania, it needs a certificate of authority from the department. That's the license that lets an insurer operate in the state. The Commissioner also watches the financial health of insurers, because an insurance promise is only as good as the company standing behind it, and reviews policy forms and rates. On rates, keep one idea in your pocket for the exam. Pennsylvania, like most states, prohibits rates that are excessive, inadequate, or unfairly discriminatory. Those three words travel together. A rate that's too high gouges consumers, a rate that's too low threatens the insurer's solvency, and a rate that treats similar risks differently for the wrong reasons is unfair. If you see any of those three, that's the Commissioner's concern. The Commissioner also enforces the rules against producers. That's you, once you're licensed. The department can investigate, hold hearings, and issue penalties. It can suspend or revoke a license, levy fines, and issue what's called a cease and desist order, which is a formal directive to stop a prohibited activity. Think of the department as having both a front door and a back door. The front door is licensing and approval, the back door is discipline and enforcement. You'll meet both in the sections ahead. Let's recap. The regulator is the Pennsylvania Insurance Department, led by the Commissioner. A company needs a certificate of authority to write business here. Rates may not be excessive, inadequate, or unfairly discriminatory. And the Commissioner holds the power to license, investigate, fine, and revoke. Next, we turn that lens on you, how a person actually becomes a licensed producer in Pennsylvania. Studying for your insurance licensing exam? Check out the My Insurance Guide flashcards app, built specifically to help you pass your insurance licensing exam with confidence. Master over 1,000 expertly curated flashcards across every insurance line. Built-in spaced repetition brings back the tough terms right when you need them, and timed practice exams prepare you for the real thing. Click the link below and download today. Now, back to the video. Before you can sell a single policy in Pennsylvania, the state asks a handful of things of you, and Pennsylvania has made this path noticeably simpler than many states. Let's walk it. First, the pre-licensing course. In a lot of states, you have to complete a set number of classroom or online hours before you're even allowed to sit for the exam. Pennsylvania does not require that. There is no mandatory pre-licensing education course to take this exam. A prep course is strongly recommended. You're watching one reason why, but the state doesn't force it on you as a condition of testing. If an exam question asks whether Pennsylvania requires pre-licensing education to sit for the producer exam, the answer is no. Second, you pass the exam, which we'll cover in detail at the end. Third, you complete a fingerprint-based background check. Pennsylvania requires new resident producer applicants to submit fingerprints through the state's approved vendor, and those prints route to the FBI for a national criminal history check. This is a standard consumer protection step. The state wants to know who it's licensing to handle other people's money and property. Fourth, you submit your application. Pennsylvania producers apply electronically, most commonly through the National Insurance Producer Registry, and pay the application fee. Once your license is issued, there's one more step before you can actually write business for a company: appointment. An appointment is the insurer formally authorizing you to represent it. Your license lets you sell. The appointment ties you to a specific carrier. You can hold a license and not yet be appointed, but you generally can't write a company's business until that company appoints you. One more distinction the exam likes: resident versus non-resident. You hold a resident license in the one state where you actually live and do business, your principal place of residence. Every other state licenses you as a non-resident. Pennsylvania grants non-resident licenses to producers already licensed in their home state, usually without another exam, through reciprocity. So the Pennsylvania path is: no required pre-licensing course, pass the exam, get fingerprinted, apply through the registry, and pay your fee. Then get appointed by a carrier before you write its business. Keep appointment equals the carrier authorizing you firmly in mind. It's a classic exam point. Next, what it takes to keep that license alive. Getting licensed is one thing. Keeping that license is another. And Pennsylvania ties renewal to ongoing education. Here are the numbers you must memorize. Pennsylvania resident producers complete 24 hours of continuing education every 2 years. Say that with me: 24 hours every 2 years. That's your baseline. But within those 24 hours, Pennsylvania carves out specific required content. And this is where the state gets particular. 3 of those hours must be in ethics. And here's the part that matters specifically for property and casualty producers. If you hold property and casualty or personal lines authority, 2 of your 24 hours must cover flood insurance. So a property and casualty producer's 24 hours include 3 ethics hours and 2 flood hours, with the rest open. If the exam asks what's required inside the Pennsylvania continuing education requirement for a property and casualty producer, that ethics and flood combination is the answer to anchor. When is all this due? Pennsylvania runs its licenses on a 2-year cycle tied to your birth month. Your license expires at the end of your birth month every other year, and your continuing education has to be done before you renew. A practical rule the state builds in: you can carry over excess continuing education hours into the next period, up to a limit, but you can't take the same course twice for credit in the same cycle. Non-resident producers are generally excused from Pennsylvania's continuing education if they satisfy their own home state's requirement. A common courtesy between states, so producers aren't doing double duty. There are fees attached to all of this: an application fee when you first license, a renewal fee each cycle, and a higher reinstatement fee if you let the license lapse and have to bring it back. Non-resident fees run higher than resident fees. Because fee amounts are the figures most likely to change over time, treat the exact dollar figures as something to confirm against current department materials before you rely on them. What's stable is the structure: apply, renew every 2 years, and pay more to reinstate a lapsed license than to renew an active one. Let's lock the core numbers. 24 hours of continuing education every 2 years, including 3 hours of ethics, and for property and casualty producers, 2 hours of flood. Renewal is every 2 years on your birth month. Mix up the ethics and flood hours, and you'll lose easy points. Now let's turn to how Pennsylvania expects you to behave once you're out there selling. Pennsylvania draws a hard line around how you're allowed to do business, and much of it lives in a law called the Unfair Insurance Practices Act. Think of this section as the list of ways to lose your license, so you can recognize each one on the exam. Start with the money you handle. When you collect premiums from a client, that money isn't yours. You hold it in a fiduciary capacity, meaning you're legally obligated to handle it for the benefit of the insurer and the insured. Keep it separate and account for it. Pocketing it or mixing it with your own funds is misappropriation, and it's one of the fastest routes to revocation. Now, the practices Pennsylvania forbids by name. Rebating is offering a customer something of value that isn't stated in the policy, a kickback of part of your commission, a gift, a special favor, to induce them to buy. It's prohibited, and the reason is fairness. Two customers buying the same coverage should get the same deal. Misrepresentation is making false or misleading statements about a policy's terms, benefits, or an insurer's financial condition. Twisting is a specific, sneaky form of misrepresentation, using misleading statements to convince someone to drop one policy and replace it with another, to their detriment. Defamation is making false statements that damage another insurer or producer. Boycott, coercion, and intimidation are attempts to force insurance business through unreasonable pressure rather than fair competition. And then there's unfair discrimination. Pennsylvania prohibits treating people who represent the same risk differently, charging different rates, or refusing coverage for reasons that don't reflect actual risk. This ties right back to what we said about the commissioner and rates. Unfairly discriminatory conduct is illegal, whether it shows up in a rate filing or in how you treat two similar applicants. Here's a scenario to make it stick. A producer tells a homeowner, "Cancel the policy you have and buy this one from me instead. Yours is about to raise your rates," when that isn't true, and quietly hands the homeowner a gift card to seal it. How many violations is that? At least 2. The false statement to induce replacement is twisting. The gift card to induce the sale is rebating. On your exam, when a fact pattern stacks behaviors like that, name each one. The test rewards you for spotting that a single sleazy move can break more than one rule. To recap the prohibited list, mishandling premiums is a fiduciary breach and misappropriation. Rebating, misrepresentation, twisting, defamation, and coercion are each separately banned, and unfair discrimination is illegal. Learn these as a set. Next, we look at what Pennsylvania demands once a claim actually comes in. Once a claim comes in, the clock starts, and Pennsylvania puts specific numbers on how fast an insurer has to move. These working day deadlines are among the most tested figures in the whole state portion, so let's be precise and note the phrase working days, which means business days, not calendar days. First deadline, acknowledgement. When an insurer receives notice of a claim, it must acknowledge receipt within 10 working days. That's just confirming, "We got your claim." It doesn't decide anything yet. It simply starts the relationship on the record. 10 working days to acknowledge. Second deadline, and don't confuse it with the first, the decision. After the insurer receives a properly completed proof of loss, that's the formal documentation of what happened and what's being claimed. It must tell the first-party claimant whether the claim is accepted or denied within 15 working days. So acknowledgement is 10 working days from notice. The accept or deny decision is 15 working days from the proof of loss. The exam loves to swap those two numbers or attach them to the wrong event. 10 to acknowledge the claim, 15 to accept or deny after proof of loss. There's a third number that pairs with these. If the insurer needs to investigate and can't complete that investigation within 30 days of being notified, it has to send the claimant a written explanation of why more time is needed, and then keep updating them every 45 days after that. 30 days to investigate, then updates every 45. One more, because the department polices this directly. When the insurance department itself sends an insurer an inquiry about a claim, the insurer must give the department an adequate response within 15 working days. Same 15 working day figure as the accept or deny rule, but aimed at the regulator instead of the claimant. Now, an important boundary. These particular claim handling timeframes apply to ordinary property and casualty claims. They specifically do not govern workers' compensation claims, which run on their own separate system that we'll cover later. Keep that fence in mind. Let's recap the clock. Acknowledge a claim within 10 working days. Accept or deny within 15 working days of a proper proof of loss. Respond to a department inquiry within 15 working days. And if investigation runs past 30 days, explain in writing, then update every 45. Those 4 numbers are worth drilling until they're automatic. Next, what happens when a claim isn't just wrong, but dishonest? There's a difference between a mistake on a form and a crime, and Pennsylvania treats insurance fraud as an actual criminal offense under the state's crimes code, not merely a licensing problem. Knowing how Pennsylvania grades it is worth a question or two. Insurance fraud, broadly, is knowingly providing false, incomplete, or misleading information to an insurer to obtain a benefit you're not entitled to, or to deny one to someone who is. Pennsylvania splits the conduct. Presenting a false or misleading claim, the classic staged accident or padded loss, is the more serious grade, prosecuted as a felony. Knowingly putting false information on an insurance application is prosecuted as a misdemeanor. The takeaway for the exam is the ranking. Fraudulent claims sit higher on the severity ladder than fraudulent applications, though both are crimes. Beyond the criminal side, Pennsylvania attaches civil penalties that escalate with repetition. A person found to have violated the fraud statute faces a civil penalty that climbs for a first, second, and each subsequent violation. The law deliberately raises the cost each time to punish repeat offenders. You don't need the exact dollar tiers memorized cold, but you should know the pattern. The penalty increases with each violation. This is also why you'll see a fraud warning printed on Pennsylvania applications and claim forms. That statement reminding the applicant that lying on the form is a crime with real penalties. And it's why insurers writing motor vehicle coverage in Pennsylvania are required to maintain anti-fraud plans, formal, filed programs for detecting and fighting fraud. The state builds fraud fighting into the machinery, not just the courtroom. Quick recap. Insurance fraud is a crime in Pennsylvania. False claims are graded as a felony, false applications as a misdemeanor, civil penalties escalate with each violation, and insurers must run anti-fraud plans for motor vehicle business. Now, to the topic that generates more state questions than almost any other: when and how a policy can be ended. Few topics on this exam generate more questions than when and how a policy can be ended, and Pennsylvania runs 3 separate rulebooks depending on what kind of policy it is. We'll take them one at a time, and the trick to mastering this is to hold the 3 side by side, because the numbers differ and the exam mixes them up on purpose. First, some vocabulary. Cancellation means ending a policy before its term is up, mid-term. Non-renewal means letting a policy run to its natural expiration and then declining to renew it. Different actions, different notice rules. And running through all 3 is the idea of an underwriting period, a window at the very start of a new policy, usually the first 60 days, during which the insurer can still look the risk over and get off it more freely than later on. Now, personal auto. For a private passenger auto policy, once it's past that initial period, an insurer that wants to cancel or not renew generally has to give the named insured at least 60 days advance written notice. 60 days, that's the headline auto number. But there are 2 situations where the notice shortens to just 15 days: non-payment of premium and suspension or revocation of the insured's driver's license or registration. So the pattern is 60 days normally, 15 days for non-payment or a license problem. Second, homeowners, what the law calls owner-occupied private residential property. Here the key figure is that 60-day underwriting window. During the first 60 days a new home policy is in force, the insurer has broad latitude to cancel as long as it gives proper notice. But once the policy has been in force 60 days or more, Pennsylvania locks the door. The insurer can no longer cancel it or refuse to renew it, except for specific permitted reasons, like non-payment or a material misrepresentation on the application. And when it does cancel or non-renew a home policy, it generally must give at least 30 days notice. So for homeowners, 60 days of underwriting freedom, then restricted with 30 days notice to end it. Third, commercial. For commercial property and casualty policies, Pennsylvania again generally requires 60 days advance notice of cancellation or non-renewal, but shortens that to 15 days for two reasons you'll recognize: material misrepresentation and non-payment of premium. And there's a separate commercial number worth holding. If the insurer wants to raise the premium at renewal, it must give at least 30 days notice of the increase. Let me give you a scenario. A homeowner has had a policy in force for 8 months. The insurer decides it simply doesn't like the risk anymore, no misrepresentation, no missed payment, and sends a cancellation notice. Is that allowed? No. Past 60 days, we changed our mind about the risk, is not a permitted reason to cancel an owner-occupied home policy. That protection is exactly what Pennsylvania built the 60-day line to create. Recap the big three. Auto, 60 days notice, 15 for non-payment or a license issue. Homeowners, free to cancel in the first 60 days, then restricted, 30 days notice to end. Commercial, 60 days notice, 15 for misrepresentation or non-payment, plus 30 days notice of a premium increase. Drill those until you can rattle off which number belongs to which policy. Next, the crown jewel of the Pennsylvania exam, auto insurance. Pennsylvania's auto rules are the heart of the state portion, and if you master nothing else, master this. We'll start with the minimum coverage every Pennsylvania driver must carry. Then, the choice that makes Pennsylvania genuinely unusual. The mandatory minimum liability limits are $1,535. Let's unpack what those numbers mean, because the exam will. That's $15,000 of bodily injury coverage per person, $30,000 of bodily injury per accident for all injured people combined, and $5,000 of property damage per accident. 15, 30, 5. Say it again, $15,000 per person, $30,000 per accident, $5,000 property damage. These are low compared with what a serious crash actually costs, which is a point Pennsylvania consumers hear a lot. But as the legal minimum, $1,535 is the number to know cold. On top of liability, Pennsylvania requires something called first-party benefits. Every Pennsylvania auto policy must include at least $5,000 in medical benefits, coverage that pays your own medical bills after a crash, regardless of who was at fault. This is Pennsylvania's version of what other states call personal injury protection, or PIP. The minimum is $5,000 of first-party medical benefit. So, a bare minimum legal Pennsylvania policy is $1,535 in liability plus $5,000 in first-party medical. Now, the choice that sets Pennsylvania apart. Pennsylvania is a choice, no-fault state, which means every driver has to elect one of two tort options when they buy a policy: full tort or limited tort. Here's the difference. Full tort keeps your unrestricted right to sue an at-fault driver for pain and suffering, the non-economic damages, no matter how minor or severe the injury. Limited tort trades that broad right away in exchange for a lower premium. You can still recover your medical bills and out-of-pocket costs, but you generally cannot sue for pain and suffering unless your injury meets the definition of a serious injury or another exception applies. Full tort costs more and preserves your right to sue. Limited tort costs less and restricts it. Two defaults the exam adores. First, if a driver never actually makes the election, Pennsylvania presumes they chose full tort. Not choosing defaults you to the broader, more protective option. Second, and in contrast, an owner who's driving a registered vehicle without the required insurance is deemed to have chosen limited tort. The law strips the uninsured owner of the fuller right to sue as a consequence. So, no election defaults to full tort, but no insurance defaults to limited tort. Those two go in opposite directions, and that's precisely the trap. There are also exceptions that restore full tort rights even to a limited tort driver. For instance, if the at-fault driver is convicted of driving under the influence in that accident, or is driving a vehicle registered in another state, or was uninsured. Know that limited tort isn't absolute. Certain at-fault conduct lifts the restriction. Let's recap these must-know numbers. Minimum liability is $1,535. Minimum first-party medical benefit is $5,000. Every driver elects full tort or limited tort. No election defaults to full tort. No insurance defaults to limited tort. This section alone is worth a real slice of your state score, so repeat it until it's reflex. Next, what happens when the other driver has little or no coverage? Say the at-fault driver has no insurance, or nowhere near enough to cover what they did to you. That's what uninsured and underinsured motorist coverage is for, and Pennsylvania has firm rules about how it's offered. Uninsured motorist coverage, UM, protects you when you're hurt by a driver who has no liability insurance at all, including a hit-and-run driver who's never identified. Underinsured motorist coverage, UIM, steps in when the at-fault driver does have insurance, but not enough to cover your injuries. Here's the Pennsylvania rule to memorize. An insurer must offer both uninsured and underinsured motorist coverage on every auto policy, but the purchase is optional. The company has to put it on the table. You don't have to buy it. And when you decline it, Pennsylvania requires you to do so a specific way. You can reject uninsured or underinsured coverage only in writing by signing a rejection form, and the state prescribes exactly what that form has to say. This matters enormously on the exam because of the consequence. If the insurer can't produce a valid, properly signed rejection form, the coverage doesn't just disappear. Instead, the uninsured or underinsured coverage is set equal to your bodily injury liability limits. In plain terms, no valid written rejection means you're treated as having full coverage up to your liability limits. The lesson: the offer must be made, rejection must be in writing on the correct form, or the coverage stands. Now, enforcement. Pennsylvania requires every registered vehicle to be insured, and driving without the required coverage carries real consequences: fines, suspension of your registration and driving privileges, and the hassle and cost of restoring them. Remember, too, what we said in the last section. An uninsured owner is deemed to have chosen limited tort, so going without insurance quietly strips away legal rights on top of the fines. What about the driver nobody wants to insure? Too many accidents? Too many tickets? For drivers who can't get coverage in the ordinary voluntary market, Pennsylvania maintains an assigned risk plan, sometimes called the Pennsylvania Automobile Insurance Plan. It's the auto market of last resort. High-risk drivers are assigned to participating insurers so that even hard-to-insure drivers can meet the state's mandatory coverage requirement. Keep the concept clear. The assigned risk plan is how Pennsylvania makes sure the legally required insurance is available to everyone, even the worst risks. Recap this section. Insurers must offer UM and UIM. Buying it is optional. Rejection must be in writing on the state's form. And without a valid rejection, the coverage equals your liability limits. Driving uninsured brings penalties and defaults you to limited tort. And the assigned risk plan is the residual market that guarantees coverage is available to high-risk drivers. Next, we move from cars to property. Not every property can find coverage on the open market, and not every policy is sold by a standard admitted insurer. This section rounds up the Pennsylvania property pieces the exam expects you to recognize. Start with the standard fire policy. Pennsylvania, like other states, uses a standard fire policy as the baseline for property coverage against fire and related perils. A common framework so that basic fire protection means the same core things from one policy to the next. You'll know the fire policy structure from your national studies. For Pennsylvania, just recognize that the state operates on that standard fire policy foundation and layers its own required provisions on top. Now, the residual market for property, which is the FAIR plan. FAIR stands for Fair Access to Insurance Requirements, and Pennsylvania's is formally the Insurance Placement Facility of Pennsylvania. Its job is to make basic property insurance available to people who have a genuine insurable interest in property, but who can't get coverage in the regular voluntary market, often because of where the property is located or its condition. It's the property insurer of last resort. Two features worth knowing. It's funded by the insurance companies doing business in the state, not by tax dollars, and it works through an inspection process. A property can be inspected to determine its insurability before it's written or declined. When you see a homeowner who's been turned down repeatedly in the open market, the FAIR plan is the answer the exam is pointing you toward. Then there's the flip side of hard-to-place coverage, surplus lines. Some risks are so unusual or so large that no admitted Pennsylvania insurer will write them. Surplus lines insurance lets those risks be placed with an eligible non-admitted insurer, a company that isn't fully licensed in Pennsylvania but is approved to accept this kind of business. It's handled by a specially licensed surplus lines producer, and the rule of thumb the exam wants is that surplus lines is for coverage that can't be obtained from the standard admitted market. You go there because the regular market can't or won't take the risk, not because you prefer it. Let's recap. Pennsylvania builds property coverage on the standard fire policy. The FAIR plan is the residual market for basic property insurance. Member-funded, inspection-based, the last resort for hard-to-place property. Surplus lines is how genuinely unusual risks get placed with approved non-admitted insurers. Now, one more property and casualty safety net, the one that catches you if the insurance company itself goes under. What happens if the insurance company itself fails? Insurers can become insolvent, unable to pay their claims, and Pennsylvania has a backstop for exactly that. It's the Pennsylvania Property and Casualty Insurance Guaranty Association, which you'll see abbreviated PPCIGA. Every property and casualty insurer licensed in the state must belong to it, and that membership is what funds the safety net. Here's how it works, and, more importantly, the limits it pays, because those dollar figures are testable. When a member insurer becomes insolvent, the Guaranty Association steps in to pay covered claims so that policyholders and claimants aren't simply left holding worthless promises. But it's not unlimited. It provides a limited form of protection, and you need the caps. The headline number: for a covered claim, the association pays up to $300,000 per claimant. $300,000 per claimant. That's the main figure to memorize. There's a separate, smaller cap for one specific thing: the return of unearned premium. The portion of premium you've paid for coverage you won't receive because the insurer failed. That's capped at $10,000 per policy. So two numbers: $300,000 per claimant for covered claims and $10,000 per policy for unearned premium. A couple of boundaries the exam may probe. The association is a limited safety net, not a replacement insurer. It doesn't put everyone in exactly the position they'd have been in had the company stayed solvent. And Pennsylvania excludes very large policyholders from first-party protection. A business whose net worth is above a high statutory threshold can't tap the association for its own first-party claim, on the theory that a large, wealthy company can absorb the loss itself. One more rule that shows up as a standalone question: you are prohibited from advertising the Guaranty Association to sell insurance. A producer may not use the existence of this backstop as a selling point. Buy from this company, and even if it fails, the state will cover you. That kind of pitch is banned outright. If a question describes a producer promoting the Guaranty Association to close a sale, that's your violation. Recap the caps. The Guaranty Association pays up to $300,000 per claimant on covered claims, and up to $10,000 per policy for unearned premium. It's a limited backstop, it excludes high net worth first-party claimants, and it may never be advertised to sell insurance. Next, an entirely separate system with its own rules: workers' compensation. When a worker gets hurt on the job in Pennsylvania, they don't sue their employer, and they don't have to prove anyone was at fault. Instead, They enter the workers' compensation system, and that trade-off is the whole foundation. So let's start there. The core bargain is called exclusive remedy. In exchange for guaranteed benefits regardless of fault, the injured worker gives up the right to sue the employer in court for the injury. The worker gets certainty and speed. The employer gets protection from lawsuits. That's the deal at the center of the entire system, and it's a favorite exam concept. There are narrow exceptions. A worker can still sue a negligent third party, like the maker of a defective machine, but against the employer itself, workers' comp is generally the exclusive remedy. How does an employer provide this coverage? Pennsylvania gives 3 routes. An employer can buy a policy from a private insurance carrier, or it can insure through the State Workers Insurance Fund, the SWIF, a state-operated fund, or, if it's large and financially strong enough to qualify, it can self-insure. 3 options: private carrier, the state fund, or approved self-insurance. Now, the benefits, and here come the numbers. Medical benefits are covered fully, reasonable and necessary treatment for the work injury, with no cost to the worker. Wage loss benefits replace lost income at approximately 2/3 of the worker's average weekly wage, up to a statewide maximum that adjusts over time. 2/3 of the average weekly wage, that's the replacement rate to remember. But wage loss benefits don't start on day 1. Pennsylvania imposes a 7-day waiting period. A worker isn't paid wage loss benefits for the first 7 days of disability. Those benefits begin on the 8th day. Here's the twist the exam loves. If the disability lasts 14 days or longer, the worker then gets paid retroactively for those first 7 days. So, 7-day waiting period. But if you're out 14 days or more, you're paid back for the first 7. Don't confuse those 2 numbers. 7 is the wait, 14 is the threshold that recovers it. A few more figures worth holding. Wage loss benefits generally must begin within 21 days of the employer being notified of the injury if the claim isn't denied. Partial disability benefits, paid when a worker can do some work but at lower wages, are capped at 500 weeks. And there are death benefits for dependents when a work injury is fatal, calculated as a percentage of the worker's wage that varies with the number of dependents. Let's recap workers' comp. Exclusive remedy is the bargain, benefits without fault, in exchange for giving up the right to sue the employer. Coverage comes from a private carrier, the state fund, or self-insurance. Wage loss pays about 2/3 of the average weekly wage. There's a 7-day waiting period, recovered retroactively if disability reaches 14 days. And partial disability caps at 500 weeks. Now, the last stop, what test day itself looks like. Let's talk about test day itself, because knowing the shape of the exam calms the nerves and helps you pace. Pennsylvania delivers its insurance licensing exams through a testing vendor called PSI, and you can take the exam either at a physical test center or through online remote proctoring from home. If older study materials you run across mention a different vendor, set that aside. PSI is the administrator to know. For the combined property and casualty exam, you'll face 150 questions and you'll have 170 minutes to answer them. 150 questions, 170 minutes. That works out to a little over a minute per question, so keep moving and don't get stuck. The questions are multiple choice, and they lean toward applying concepts to situations rather than reciting bare definitions, so expect scenarios. The passing score is 70%. You need to answer 70% of the scored questions correctly to pass. That's your target, and it doesn't move based on how anyone else does. There's no curve. Your result depends only on your own performance against that 70% line. A few practical rules. If you don't pass, Pennsylvania lets you retake the exam. There's no cap on the number of attempts, but you have to wait at least 24 hours before scheduling the next try, and you pay the exam fee again for each attempt. Speaking of the fee, you pay PSI an examination fee when you schedule, and that fee is generally non-refundable and non-transferable, so be sure you're ready before you book. And once you pass, your passing result stays valid for a limited window, about a year, during which you need to complete your application, so don't sit on it. Quick recap of test day. The vendor is PSI, in person or remote. The property and casualty exam is 150 questions in 170 minutes. Passing is 70%. Retakes are unlimited with a 24-hour wait between them, and your passing score is good for roughly a year while you finish licensing. Now, let's pull the whole thing together. You've just built the Pennsylvania layer that sits on top of your national property and casualty studies, so let's do a final sweep of the numbers you most need to carry into that exam room. On auto, the minimum limits are $1,535, with at least $5,000 in first-party medical benefits, and every driver elects full tort or limited tort. No election defaults to full tort, no insurance defaults to limited tort. On claims, acknowledge within 10 working days, accept or deny within 15 working days of proof of loss. On cancellation, auto is 60 days notice and 15 for non-payment or a license problem. A homeowner's policy can be freely canceled only in its first 60 days, then it's restricted with 30 days notice. Commercial is 60 days and 15 for misrepresentation or non-payment. On the Guaranty Association, $300,000 per claimant and $10,000 for unearned premium, and never advertise it. On workers' comp, exclusive remedy, about 2/3 of the average weekly wage, a 7-day waiting period recovered if disability hits 14 days, and 500 weeks for partial disability. And on continuing education, 24 hours every 2 years, including 3 ethics and 2 flood for property and casualty producers. If those numbers feel like a lot right now, that's normal. Come back through this video, drill the recaps, and let the repetition do its work. You know this material better than you think, and every time you review it, those figures get a little more automatic. You've got this. If this helped you get ready, do us a favor and give it a like and subscribe so the next state topic finds you when you need it. Now go pass that Pennsylvania Property and Casualty exam.